What's up, guys? It's Mr. Fit to Flourish, and this is going to be part two, quick video, part two on what options are and how to trade options. So let's get right into it. So the first part of the options course, I'm going to link right here, and I'm also going to link at the end of this video. But the first part, what did we talk about? We talked about what a stock is, what options are in relations to stocks. So we talked about how stocks are securities or equities, and they're measured in shares, and then pretty much options are just buying insurance on a stock. And when you buy a call, you're betting that a stock is going to go up. When you buy a put, you're betting that a stock is going to go down. Okay, and it's a way to hedge. It's a way to hedge. All right. And we talked about options. Options are derivatives. They're wasting assets. We talked about examples by buying shovels in the snow. We talked about that example, and we talked about, hey, how do you open an options account? You download a broker like Robinhood, Webull, TD Ameritrade, all that stuff, Moomoo, any of those, okay? Now let's get into it. Let's get into the complex stuff. So what is the option multiplier? So an option, if you buy an option for 0.13, you actually pay $13, which is called the premium. Why? Because there's a multiplier, all right? So the multiplier is 100, which means that you are in control of a block of 100 shares. So when you buy an option, you're basically buying a block of 100 shares. So you always multiply whatever number you see, you multiply it by 100. Okay, multiply it by 100, and this is the premium. So what's the premium? The premium is the price of an option contract. Okay, and the basic options formula, people don't talk about this. Pay attention. The basic options formula goes like this. Okay, the intrinsic value is equal to the stock price minus the strike price. So this basically means that this is how much that you can turn in the option contract for. And there's intrinsic value and there's extrinsic value in the money option contracts. And then out of the money, they really only have extrinsic value, which means value that comes from time and volatility. Okay. So this intrinsic value is what you can turn in the option for. So the exercise, when you exercise the right to sell your shares. Okay, and we'll talk about what that means in a second here. So again, that formula is the stock price minus the strike price, and this is the in the money portion. Okay, that's your intrinsic. Extrinsic value is made up of volatility and time. So what do I mean by volatility? That means like volatility is pretty much how what events are going around to cause fluctuations in this stock. So for instance, if Tesla says, hey, we have a vehicle that's going to take us to the moon, then like a lot of people are going to start trying to buy and sell Tesla. They're going to start buying it up, and Tesla's going to move dramatically. The price of Tesla is going to move dramatically, which is going to cause the options contracts to change dramatically as well, which is then those fluctuations are known as volatility. Okay, so that volatility can cause massive increases or decreases, usually increases in the contract prices. Okay, so that's what we call extrinsic value. Also, the amount of time that you have before the contracts expire, because remember, options are wasting assets, that goes into the value of a stock, of a contract, as well as the option contract. Okay, so if an option contract is expiring today, there's not really that much time. So that time portion is going to make up a small amount of that contract. But if the contract has 5 weeks, 6 weeks, 7 weeks to expire, then it has a long time till it expires. So that time portion is going to make up a lot of the contract. Okay, so that's an extrinsic value. Again, intrinsic value is the stock price minus the strike price. So that means there's only intrinsic value if your contract is in the money. Okay, so in the money options have intrinsic and extrinsic value. Out of the money options, they literally have no real value. They only have extrinsic value. This is a huge concept. It might not make sense now, but just take note of it because it's pretty serious. It's pretty serious. And this is what makes up the premium, which is the actual value of your options contract. So nomenclature, okay? Let's take a look at the naming of options. And what do I mean by in the money? What do I mean by at the money, out of the money? Okay, so let's take a look at stock price. So stock price is listed here on the left-hand side here. So people usually get calls. So right now we're looking at calls. So let's pretend we're betting that the stock is going to go up. Okay, so currently it says the current stock price is $43, which means that if the current price is $43, that means it is at the money. This option contract is at the money. Now these option contracts up here are in the money. What is in the money? In the money, all it means is it's just a price that we passed already. Okay, so we're getting calls. We're betting the stock is going up. So these prices here, $40, $41, $42. We passed those because right now the stock price is $43. So that means that those contracts, if you get these contracts, they're more expensive, but it's called in the money because we passed them already. Okay, they're in the money. In the money contracts are usually more expensive. Okay, what are they more expensive than? They're more expensive than out of the money. So these are out of the money. If we're getting calls, these are out of the money. Why? Because the stock price here is $44, $45, $46, $47, and these are the contract prices associated with these strikes. Okay, with these strikes. So again, the current price is $43. We have not gotten to 44. We haven't gotten to 45. Okay, we haven't gone past that because we're thinking the price is going to go up. Have we gone past those prices yet? No, we have not. So therefore, we have not gone in the money. These are out of the money. Okay, so I'm just going to back out so you can see this again. And these prices are just for example purposes only, for the concept. These prices don't make sense right here, but for these option contracts, and you'll learn why later on in some of my videos. But just understand that as you go out of the money, contracts get super cheap. In the money are more expensive, okay, because they actually have more value. We talked about why, because there's extrinsic and intrinsic value, but then out of the money contracts only have extrinsic value. Options further explain what the heck is a strike price. So strike price is the predetermined price where the option can be exercised. Okay. Now, exercising just means that you're using the option contract to buy or sell the stock at an agreed upon price. So if you think the price is going to go up on an option, if you think the price is going to go up on a stock, then that's called a call option. You're betting that the stock is going up. And what does it do? What does an option actually do? So when you get a call, you're reserving the right to buy the stock at that price. Because, for instance, if a stock is at $100 and you buy $101 calls, you think that the stock is going to go past $101, but you want to still be able to get and buy that stock at $101 if the stock continues to fly. Like if it goes to $120, you're reserving the right. So you're paying for a contract that reserves the right to still buy that stock at $101. This is a big deal because you're able to just still pay that small amount even though the stock is flying. So that's what call options mean, okay? That's what call options mean. And then what is a put option? So a put option is you think the stock might go down, you're reserving the right to sell that stock at that price. So if the stock is at $100 and you get a put for $99, and because you think the stock is going to fall, the stock falls all the way down to $50. Well, guess what? You bought a contract that reserves the right for you to sell that stock at $99, even though the stock is $50. It's like a cheat code. So options is like a cheat code. And it's buying insurance on a stock based on what you think is going to happen. Okay? So options have expiration dates that usually land on Fridays. So if they're expired, then the option is worthless and cannot be exercised. You lose the premium you paid. Okay? So again, going long options is a bet. Okay? Going long options is a bet. So going long options just mean that you're buying calls or you're buying puts. Okay. There's different ways to do this. Like you can sell them immediately. You can do combination strategies. We're not going to talk about that in this video. You need to learn what options are first. Okay. So calls is a bet that the stock is going up, and puts is a bet that the stock is going down. Okay, stock is going down. Now this video is getting a little bit long. I don't want it to be one of those 2 billion hour videos on stock options, so just follow this series. This was part 2. I will go into part 3, part 4, part 5, and then we're going to get into complex strategies for options trading, because I want everybody to be empowered to learn how to trade and learn why things are moving the way they move, how they move the way they move, and why you want to choose one instrument over another. Futures, options, shares, all of that, commodities. Let's learn. Let's learn how to invest. Let's learn how to trade. It's your boy, Mr. Fit to Flourish, and I'm out. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance,